So do you want to hear something that's absolutely insane? Based on the data in the MMT, funded traders make an average of $13,280 within the first 3 months of consuming our content. Now that's insanely fast, and it's better for you to assume that it might take you longer. So the money-making team is in fact making money. But how can we make sure that you get there as well? By mastering the 3 concepts in this video. Every concept that we're going to go over adds on to the previous concept. So the first concept is market structure. In market structure, we work with the following: intermediate term highs, intermediate term lows, short term highs, and short term lows. So an intermediate term high is this high right there, and an intermediate term low is this low right there. What makes this an intermediate term high? An intermediate term high is a swing high, so that 3 candle pattern again, with a swing high lower to the left of it and lower to the right of it, like we have with this intermediate term high. The intermediate term low is the exact same thing, just opposite. So we have a swing low higher to the left of it and higher to the right of it, making it an intermediate term low. Intermediate term highs, intermediate term lows, they make the outsiders of the market. What I mean by that is if you want to understand the overall structure of where the market is going, then pay attention to intermediate term highs and intermediate term lows. They are always on the outside right here. So we have intermediate term high, intermediate term low, intermediate term high, intermediate term low right there again, and then creating a new intermediate term high right there. That makes them outsiders. Now in between this intermediate term high and that intermediate term low, we have something called short-term highs and short-term lows. So if we expect higher prices, we expect short-term lows like these, for example, to hold. Those short-term lows are nothing more than swing lows with a fair value gap in the same leg. So what is that same leg? Well, when we create that swing low right there, immediately after, we want to see a new fair value gap being created before we get a new swing low. So the order should be swing low, fair value gap, swing low again. But it should not be swing low to then a new swing low already. Because when we have a swing low, directly after that a new swing low without a fair value gap in that leg, that tells us that that leg is not as high probability, not as strong as a leg with a fair value gap in it. For example, this right here. We have this swing low right there, followed by a fair value gap, makes this right there a short-term low, a strong short-term low. Afterwards, we create new swing lows, but not new fair value gaps, making those not good short-term lows, not strong short-term lows. Then what you'll see is when moving towards an intermediate term high, for example, you will see short-term lows right there holding until we reach that intermediate term high. That is important to understand because in concept number 3, we're going to get back to that. All right, so we have that understanding of concept number 1, market structure. Check it off. Concept number 2 is institutional. Why institutional? We want to make that market structure institutional market structure. By understanding that, we need to divide the two into institutional and market structure, and then we get an idea of what the institutions actually want to do. So for the second concept, institutional, we use the following theory. The market is always doing one of two things. It is either offering fair value or it is seeking liquidity. So let's start with the first one, offering fair value. What is offering fair value? Well, the market is based around fair value. Everything needs to be fair value to actually continue higher or continue lower. That's also a reason why we use fair value gaps. So what happens right there? When we have a move higher, only buy side is offered right there. Then that means only buyers got a fair chance to get involved. So we create a retracement. Why does that retracement happen? Because that is offering fair value right there, where sellers also get a fair chance to now get involved. Now, once we finish the retracement, we continue higher again. That means in that area of the retracement, so from the high towards the low of the retracement, we have offered fair value. That high towards the low of the retracement is now a fair value area. What does that mean? That fair value area means that we have already offered fair value right there. So every bit of price action on the buy side above the retracement leg right there, that is the area where we have not offered fair value yet. In other words, that fair value area tells us how far we can retrace. So in this example here, we see that we have a first move higher right there. Then afterwards, we get a retracement. So in this example, we see the same thing. We have a buy side move higher right there. Only buyers at that moment in time got a fair chance to get involved. So we need to create a bigger retracement right there. When we create the retracement, now sellers also got a fair chance to get involved. So both buyers and sellers got a fair chance to get involved. In other words, fair value has been offered once we move above this high right there, making this whole retracement area from the high from the retracement towards the low of the retracement, the fair value area. And the only area where we have not offered fair value just yet is the area above that high. So how far can we retrace? We can retrace as far as the fair value area to then continue higher off of it. And now the same thing happens right here where this full section is fair value. So there's no reason to create a very big retracement anymore before we continue higher. Fair value areas are a more advanced understanding and a group name of the following 3 PD rays: order block, mitigation block, and break block. Those are all fair value areas. And what can we now notice when we put market structure and institutional together? We get institutional market structure. Why? Because the fair value area is the area from the intermediate term high towards the intermediate term low right there. The same for this intermediate term high towards that intermediate term low creates a new fair value area. Now, is a fair value area always from an intermediate term high or an intermediate term low? Not necessarily, because it depends on which time frame you are. As in currently we are looking at the daily time frame, but if I zoom out right there, then this fair value area right here is actually a short-term high and a short-term low right there, a short-term low creating a new fair value gap. So these fair value areas, they are all fractal. So if we again understand the fair value areas on the higher time frame first, and then we can move on to the lower time frame, then that gets us a very strong and important understanding of what institutional market structure wants to do. Now that was the first part of understanding the institutional concept, which was again offering fair value, those fair value areas. The second part is seeking liquidity, because again, if we are not offering fair value, we are seeking liquidity. So what does that mean? Well, right here, we have the same thing. We have to move higher, buy side right there. We offer a retracement right there. That retracement is offering fair value. We move higher, and here we have only one area above the high that we just took right there, where we have not offered fair value yet. So how far can we retrace? Well, if we want to offer fair value and continue higher afterwards, then we can come back towards the high that we took to then continue higher. Because here, all the fair value is already offered. There is no reason to create a deeper retracement anymore. But what do we then see? We see a fair value gap, an aggressive move right here, coming back deeper into the fair value area. Now let's look at this from a logical perspective. Why does that happen? If the market is doing one of two things, offering fair value or seeking liquidity, what is happening at that moment in time? Have we offered fair value? Yes, we have already offered fair value. So why is it retracing deeper? To seek liquidity. Because we are not offering fair value anymore at that moment in time, because that's already done. So what are we doing? We are now seeking liquidity. What is the liquidity that we're seeking? Well, that is where the institutional market structure again comes in. The fair value area was from the intermediate term high towards the intermediate term low right there. So if we are not offering fair value anymore and we're not continuing higher of the intermediate term high in a bullish scenario, and instead we are aggressively moving with fair value gaps going lower right there, that tells us that we are seeking liquidity, and that liquidity is the intermediate term low, the low of the actual fair value area. And again, that is fractal, right? Because it's also a weekly fair value area sitting right there. Where on the weekly, we would argue that we are targeting the short-term low right there. All right, concept 1, market structure, intermediate term highs, intermediate term lows, short-term highs, short-term lows. Concept 2, institutional. So adding that story of offering fair value, seeking liquidity. So we won't get stuck trying to trade a certain bias because we already know fair value has been offered. Now we can potentially seek liquidity. Now, the third concept is where we can now start making money from it. The third concept is market maker models. So when we have this bullish fair value area right there, there's two scenarios that can happen. Either we are going to offer that fair value where fair value has not been offered yet, like we discussed, to then continue higher off of the fair value area, off of that intermediate term high. Or like we mentioned in this scenario, when we are not offering fair value anymore and we fail to continue higher off that intermediate term high fair value area, then we can start seeking liquidity in the form of the fair value area low, the intermediate term low right there. So when we have that fair value area, there's always something for us to do. The first assumption when we have a bullish fair value area is, can we create a market maker buy model? But if we do not respect that fair value area, can we then look to trade off of that market maker sell model? There's one thing in between, and that is when we start to consolidate. At the end of the video, I'll attach a link where you can go ahead and learn about consolidations and what you should do for absolutely free. So in this scenario, we have our fair value area sitting right there. We retrace back into that fair value area. So if we have now offered fair value, we should continue higher. We should not create a deeper retracement. Then if we want to continue higher, how can we know it wants to continue higher? Well, through fair value gaps. So here we create this daily fair value gap right there, which already tells us there's intention that we want to actually move higher right there. In that daily fair value gap right there, what do we actually do? Well, here we create a new short-term low. Once we have this first short-term low, what actually happens in that market maker buy model? Well, here, this intermediate term low is confirmed as soon as we create this short-term low, which should again leave behind a new fair value gap. So this trade right here is the highest probability trade that you can have. Then from this fair value gap towards this high and the eventual target, which is the intermediate term high right there, that is what a lot of people also know as the original consolidation in a market maker buy model, which is simply the intermediate term high right there, which then afterwards creates again that fair value area. Then in this fair value gap, let's go into the 1 hour to confirm that and see how we can potentially enter. So the gray box right there is the fair value area. This right here on the 1 hour is now the intermediate term high, which on the daily was a short-term high actually, which is our overall target. After coming into this daily fair value gap, we can see that we now have a fair value gap higher right there on the 1 hour. That in itself is already enough to look for an entry. The overall delivery afterwards is very messy, but when we reach that intermediate term high right there, what happens? The same thing. We have now created a fair value area right here, where we should not create a deep retracement back into that fair value area from the intermediate term high towards the intermediate to low, to then continue higher off that fair value area towards the next target right there, the bigger daily fair value area that we had. And then off of that daily fair value area, which is also right now a weekly fair value area right here, we can potentially look for the same thing. Can we continue higher right here off of this fair value area? But let's say we don't offer fair value right there and we actually continue low right here and we start seeking liquidity in the form of this low right there. Then how can we still make money from it? So here we have again this fair value area. We come into it. What is the difference what we just saw in the different scenario when we are offering fair value to continue higher? We don't have a clear expansion higher. We don't have that fair value gap to push higher from right there. We struggle to push higher. And afterwards, we take out the full rejection and we actually create a bearish fair value gap right there, which to me shows, okay, we have a lot more bearish intention at that moment in time than bullish intention. We might not be offering fair value anymore and we are seeking liquidity instead. So this daily fair value gap is exactly what we can look to trade off of. And what becomes the target? This intermediate term low right there, creating the market maker sell model towards that intermediate term low. And what do we also see? We have an earlier swing low right there. Now, why is that swing low important again? Because now when we go into the 1 hour and we look for our 1 hour sharp turn entry right there, once we come into the daily fair value gap and we enter off the creation of the fair value gap right there. You can enter off the creation of fair value gap. So what that means is You do not wait for a sting back into it. You enter as soon as the third candle closes. You can do that if the RR is still worth it, meaning the next target, first target, is sitting right there. Do we have an easy 1 to 2 within that area? Perfect, very easy. So we can already enter off the fair value gap creation. Now, once we reach this low right here, what is that? That is an intermediate low, which that intermediate low towards that intermediate high, the intermediate high, which stings into that daily fair value gap. On the 1 hour right here, we have now created a new fair value area, which we can again continue lower off of right there until we reach this next target right there, which is the daily intermediate term low that we saw right here. Both scenarios, the market maker buy model and market maker sell model right there, is what we went over before they of course played out in the MMT, where we can again make money from it. Now, for your own study, take a look at New Zealand dollar CHF with this fair value area, and Euro US dollar as well with this fair value area right there. Will we still continue higher, or will we start seeking liquidity? Now, making money is a lot of fun, but most traders lose all the money that they made in the next consolidation. So how do we want to approach and avoid those consolidations? That is where you can check out my completely free newsletter. There's a link in the description and you can view the online version. All right, perfect. Thank you.